Hmm. Yo, what's up for everyone that's watching this on the YouTube replay? I hope you are having a great Sunday. I want to start this off quickly by going over some stocks that I think are going to be pretty interesting to watch next week. I made a little watch list here of some stocks I find pretty interesting and ones I would definitely own. And I actually want to start this video off by going over MCore. It's actually a huge competitor to Comfort Systems. A while back, like 10 years ago, Comfort Systems had to sell off a lot of its like smaller business subsidiaries off to MCore Group right here. So these are two very similar MEP plays, and MEP is mechanical, electrical, and plumbing, and right now they are in such demand from data centers. And this company we're talking about, EME stock, is only trading on the right at a 24 forward PE. So right now at current valuations, it actually doesn't seem too crazy to potentially nibble on the stock right now at a 24 forward PE. So yeah, 41% is their mechanical construction doing the complex MEP work for data centers right now. That grew double digits. It's up 17% year over year. After grew 9%. So that's their main business, their MEP work. Yeah, so that was that was specifically right here, their mechanical work. Here is their electrical construction work. And check out the boom of this one specifically, because same with Comfort Systems. This has been the real winner. It's up 44% doing the complex electrical work for data centers right now. So that's up 43%. After grew 24, after grew 8%. So they're just on a good streak of growth, and they beat expectations on earnings this quarter. If we check down here what the orange lines, that's what the analysts expect. They expected 4.28. They did 4.51 of revenue. And they expected 300 mil in net income. They made 400 mil. And it basically, excluding that, they had a slight adjustment to make that look higher. But if we just look at EBIT right here, earnings before interest taxes, we can see it really was a beat by over $30 million. So that's what I find fascinating about this stock. They're also a dividend growth company. Yeah. I think you'll find this very impressive. So look at this. This quarter, again, it was a slight adjustment. They only made around like 390 million actually, but still, let's just say like if we average out the 4 quarters, they're easily making over 300 million a quarter. So if they're making 300 million a quarter, how much does their dividend cost? That dividend that they pay only cost them $11 million. And since they have so much leftover money, they're just buying back their own stock like crazy. Like, check this out. Like, look, they're not actively diluting you. They're actively buying back like a couple hundred million of their shares every quarter. So they're doing share buybacks, they're doing dividends, and let's see if they're doing M&A. Yeah, they are. So I have no real complaints about this stock right here. So it's just a nice MEP play to benefit from data center construction. You get a small yield, but again, the yield is accompanied by a very low payout ratio, only a 3% payout ratio. So yeah, this is MCore stock, a competitor to Comfort Systems. They do the same thing, but they should both benefit together and continue to climb up higher together, in my opinion. So the next stock I actually want to go over is a very growthy one. And unfortunately, this one is too expensive for me to pay, but this is a stock I would love to own. There's still a good bit off all-time highs. Like if or was that the all-time high, like $190 or $183, and now it's $130. But let me show you what's so impressive about Shopify stock. This is their annual revenue growth. As you can see for the full year 2025, I mean, it's just a record up 30% from the previous year. This is the kind of growth I want to pay for and see when I'm buying a stock. So actually, if we just scroll back to the revenue right here, this needs to be rewarded. This is a huge e-commerce company. I believe they're headquartered in Canada. They might be Canada's like biggest company, but they have a fortress balance sheet too. This is another huge cherry on top about Shopify. They literally have no debt at all. So it's a debt-free company. Yeah, Shopify right here. So it's pretty good. Yeah, they're headquartered in Canada. So yeah. Let's see. And then 63% of their revenue does come from the US, but they print free cash flow. They had a slight one-time adjustment to their net income. But if we just look at their free cash flow, record free cash flow on the right there. They're like the most profitable. Oh my goodness. They're the most profitable they've ever been. The free cash flow is 700 million this quarter. And if we go to net income, again, they've been having these weird like one-time adjustments. It said they only, actually that might be accurate, or let's see. Yeah, so actually, here's what we should look at. This is their before adjustment numbers. As we can see, this quarter specifically was the most profitable quarter that they've ever had. And this doesn't include the adjustments. So anyway, I'm actually very impressed with Shopify's numbers. Like, here's their profits. So the revenue's up 30, but the profits are up 37% year over year. So their margins are going faster. The only bad part is, yeah, let's check out the forward multiple here. Again, good growth companies usually have high multiples, but on the left, it says they're trading at 140 times earnings, but since this is a growth company, you want to look at the forward multiple. They're at 87 times next year's net income. Still too expensive for me to pay, but I'd love to get this one if I could get them at the right price. Just because they're so quality, I use Shopify, or not. I used to have a Shopify store, and even if you pay for the highest tier Shopify subscription, they make you, or still 0.25% of every single sale goes back to Shopify as literally a royalty. So they just collect high margin royalties. So next up is a stock you've maybe never heard of before. I didn't even know they were public, but this one's been on my watches for a while. This is ticker symbol PAG, Penske Automotive. And since they're an automotive company, they do trade cheap, but that's what I like about them. If you look on the right, they only trade at 12 times next year's net income. Okay. And so retail automotive, where's the revenue come from? So 60% of the revenue comes from the US. Retail automotive's 85% of the revenue. But my favorite part is this net income right here. Like if we zoom out, I mean, they're easily making and it's trending down right now. That's the bad part. That's why I think the multiple is low at a 12 multiple right now, because it is slightly going down right now just because of the whole market. But look at this. They're easily making 200 plus million of net income a quarter if we average it out. So they're making over 200 million in net income a quarter. Well, they pay a 3% dividend, I believe. Yeah, so check this out. The dividend cost them $87 million, and they're making over 200 mil a quarter. So as we know, they can easily afford their dividend. And since they have leftover money, they're even doing share buyback. So that's how we know they're in a comfortable position. But check this out. Yeah, if you buy the stock right now, you get 3.3% of your money back just in dividend every year. And the payout ratio is only a 36% because they're making over 200 mil a quarter. Dividend cost 83 million or whatever, 87 million. We just kind of want to see the net income and sales start to rebound. And let me actually check the analyst expectations. And we're going to see that. Look at that. Revenue is going to go from 7.66 to 8 billion in 2 quarters. Let's see the net income on that. Yeah, net income is going to be 226. So they're easily making over 200 mil in net income a quarter. They pay out 87 mil a quarter. It just seems like a niche one, with the low multiple, 12 forward PE, 3.3% dividend yield. The stock is still done pretty good. Like there's their 2019 price, and this doesn't even include the reinvested dividend. So the chart looks even better when you look at the dividends reinvested. So yeah, that's PAG. Hopefully that's a new stock you've probably never heard of before. Hey, what's up, Catherine? Here, let me go over one more stock, and then I see some stocks from you guys. Like I see Adobe, AMD. I do own some AMD stock, full disclosure, and I also own UiPath as well. So last stock, or maybe 2 more here. I forget, what is OSW. There was something about the stock that I found interesting. It's like a leisure company right here. So this is One Spa World, and I normally don't cover these kind of stocks, but this one I found interesting because they're at a 23 forward PE. So they only trade at 23 times next year's net income. And if we go to their services revenue right here, this is what you want to see, especially if we look at what happened in 2020. The revenue fell to 93 million for the full year. Well, this year it's 777 million, a record. It's never even been close to that before. And the revenue's up 12% year over year. What's their product revenue like? Wow, that's also at a record, 45 million this quarter. And they sell this at a pretty decent margin. I mean, it's not crazy. So the revenue grew 11% year over year. So they're doing like 200 mil plus of revenue a quarter. And then they have like a 10% net margin, making around 20 mil in net income a quarter. So I just like that they are making net income every quarter. Oh yeah, and they have no debt. So that's a good balance sheet, I believe, or no net debt. The cash is getting low right now. Actually, I don't know about this stock right here. I mean, they're making good free cash. The numbers are kind of tiny. Let me see what they do again. Oh, they pay a dividend too. So yeah, this is a leisure company. What is One Spa World? Is this like a, they sell products? Is it maybe like a hotel? I don't know. Some wellness time to spa company? Huh. Anyway, I don't know. I just wanted to go over them because I forgot about what they do. Hey, what's up, Looney? What's been your latest buy, Nathan? Hey, my latest purchase has actually been ticker symbol MOOG, or MOG.A. This is MOOG right here. It's an aerospace, defense, space, data center stock. I just made a whole bunch of posts about this one if you want to learn more about MOOG. So yeah, we bought them literally on Friday. We're only up 1%. When's the next 3 stocks I'm buying now video? Hey, what's up, Isaiah? Good to see ya. I might try and make one of those today. All right, let me switch over here. Okay. Petra Brazil Oil has been a good one. Yeah, everything oil. Yeah, what's the ticker symbol for that one? I don't know, but if yeah, we just look at the most popular oil stock, like an Exxon Mobil. I mean, they're at an all-time high right now. So as we know, if you've filled up your gas tank recently, you know oil prices are pretty ridiculous right now. So yeah, Exxon Mobil is at an all-time high on this news. We kind of want oil prices to go down for the greater good of the economy. It's kind of just like a added tax everyone has to pay just to go A to B. Yo, what's up, Aaron? Good to see you. I hope everyone's having a great Sunday. So next up, I saw someone talk about Adobe. I think they report earnings. Yeah, with earnings coming up this week. When did they report earnings? So on March 12th, and today is the 8th. So yeah, this week we get Adobe earnings, and all eyes are really going to be on Adobe's earnings because this is one of the companies really getting hurt by the AI thesis right now, or really the AI replacement thesis. They're saying in 10 years from now, will we need Adobe? Will we need Photoshop and After Effects? You know, if the AI is so good that we can just AI generate a thumbnail or a logo in ChatGPT or Gemini, we might not need Adobe. So that's the future thesis around this stock. You know that. So it's the sentiment is hurting. It's not like the actual fundamentals are hurting because they're literally beating on like net income numbers every quarter. Like they're beating on every metric every quarter. It's just a sentiment. Like it's literally Adobe's not falling because they're missing like crazy on their numbers every quarter. They're actually beating on their numbers every quarter. It's just a sentiment. So Adobe's one of the cheapest they've ever been. And I'm kind of a believer that in the long run, humans are always going to need that final touch on art. You know what I mean? But it's certainly still something to keep in the back of your mind if you're a shareholder. Like maybe the demand for Adobe will go down. But yeah, if we look on the right, they're now very dog cheap at they're trading at 15 times next year's net income. They have a good subscription business model. This is their after-tax net income. They made 1.86 billion net income, after they paid 350 or 400 mil of taxes. So they made 1.86 billion. What's Adobe doing with all this like 1.8 billion of net income every single quarter? Well, let me show you this. The best part about Adobe is actually the share buybacks. If you look at the top here, they're easily buying back like 2 to 3 billion of their own stock every single quarter. And that's what I love about them. But Michael Burry actually is talking about this stock. Michael Burry urges Adobe to acquire AI firms. So, Midjourney. If anyone's heard of Midjourney before, huge like art AI generation platform. I'm in their Discord and stuff. Michael Burry just took a huge position in Adobe. He sees this SaaS apocalypse is oversold. Trades at a PE of 16. So, yeah, pretty interesting on Adobe. You just got to think about that long-term thesis. And they report earnings this week, so all eyes will be on that. I think it's just a lot of fear for Adobe. Yeah, what I'd like to see Adobe do is, how they're doing like billions of buybacks a quarter. I actually agree with Michael Burry. They need to do some acquisitions. Instead of buying back 10 billion of your stock a year, maybe buy a company for $10 billion like Midjourney and maybe fix the sentiment and don't get out innovated by Ooh, I saw don't get out innovated by this AI thesis. So someone said Innodata. This is one of my favorite nichier, smaller software stocks. I like this one so much I decided to buy them. I've owned this one for a while now, a couple months, but they're in my Roth IRA. And again, they're one of my smaller positions. Actually, they're my smallest position. And they're my smallest position for a reason. I don't want a crazy amount of money in Innodata stock right here. But they have some great customers like Meta, Google, Amazon, Microsoft. They're all their top customers. 5 of them Magnificent Seven are customers. They just got a huge contract deal with Palantir and a Golden Dome contract to help defend the U.S. Golden Dome program. So anyway, yeah, they're a data labeling company. That's 87% of the revenue. It's grown very nicely. They're just beating on every expectation every quarter. Like, check this out. They expected, you can see every quarter, the orange line's what the analysts expect. They beat on revenue every quarter. They beat on net income every quarter. Like, that's the cool thing. This is a company that's already making net income. They had a slight one-time adjustment this last year. So it says the net income's down 50%. It's not actually. It's at a record this quarter for this quarter. But yeah, I really like them for being this small. The whole company is worth 1.47 billion. Out of all the companies that are worth 1.47 billion, I want to buy the one that's growing their revenue like this, that has those incredible customers, that makes net income every quarter, and has no net debt. They're actually fortifying their balance sheet. Look at this. The liabilities used to be 46% of their assets. Now it's only 36% of their assets. So anyway, they just seem pretty nichey to me. They're also making free cash flow too. Yeah, here's their FCF, which stands for free cash flow. These year-over-year growth rates look incredible. So I'm really just bullish, just like as a smaller cap to just hold a couple $100 of just to see what happens these coming years. Ooh, Sonny said Rolls Royce. That's ticker symbol RR, I believe. or RYCEY. So this is actually a European stock. A lot of people know Rolls Royce for like their luxury cars. Hey Rand, thanks for all those gifts there, dude. I do appreciate that. If you have a stock you want me to look at, let me know there. Happy Sunday, everyone. So yeah, Rolls Royce. This is a lot of people know them for their cars, but this is actually an aerospace and defense stock. Believe it or not, they make jet engines. Actually, well, I'll just show you for yourself. Look at this. 50% of the revenue, I don't think people knew this, is their aerospace business for Rolls-Royce. So 50% of the revenues are civil aerospace, 24% is their defense systems, and then another 22% is their power systems. So that's why this stock has done so well. If you look at a lot of car stocks like Ferrari or Ford or whatever, they're all doing bad. But if you look at all the aerospace and defense stock, they're doing amazing, just like Rolls-Royce, because they're really an aerospace and defense stock. US is only 28% of the revenue. I like how geographically diversified that they are. And the forward PE, I guess it's a 34. I guess that's a little expensive at a 34. But really, a lot of these aerospace and defense names are really expensive right now, just because of all the war fears around what's happening in the Middle East and stuff. But yeah, we can see how greatly they have improved their bottom line. Again, since this company is a European, or actually, no, they're a British pound. So we're actually going to convert the currency from British pounds to US dollars. So this is in USD. They report in halves in full years because they're British. But for the full year 2025, as we can zoom out here, they really do make good net income every quarter in US dollars. Like for the first half of 2025, they did $6 billion. For the full year 2024, they did $3 billion net income. Look at that. They used to have more liabilities than assets. Now they have more assets than liabilities. Pretty interesting here, except the fact that they're a little expensive. But yeah, you get in your 1% dividend, 15% payout ratio. Yeah, Rolls-Royce is actually pretty interesting. Okay, what's next here? Joe said Symbiotic. Yeah, let me do Symbiotic really quickly. This is my favorite like robotics company. If you're looking for a real robotics stock to get exposure to, this is one of the best ones, if not like the second best one behind Amazon. So they have over 1,500 registered patents. And I've looked at a lot of robotic stocks out there. Rich Tech Robotics, Serve Robotics, those are all pretty junk, especially Rich Tech Robotics. But here's a company with real revenue and real growth. Check this out. They did 630 million in revenue, up 30%. After grew 35, after grew 47. That is impressive top line growth. And that's why I like this one. And they're not just growing their revenue, but for the first time ever, they finally got profitable. So if we go to net income, this quarter, they made 14 million net income. Probably by the same time next year, they're going to be consistently making net income every quarter. Now, but you're wondering what kind of robotics company this is. This is a warehouse robotics helping out many popular S&P 500 companies. Their largest customer is actually Walmart. So this is a warehouse robotics company. And that's what I'm really bullish on, warehouse robotics currently for the real today's use for these robotics, not like humanoid robotics yet, but they really help out the supply, like the logistics for shipping and stuff, and saves money like crazy on humans. It goes and gathers the stuff from its little spot. So anyway, over 1,500 patents. And guess what? Since their biggest customer is Walmart, Walmart likes them so much that Walmart decided to buy the stock. If you look at the second largest shareholder, Walmart owns 12% of all the shares. They're the second largest shareholder. So anyway, that's what I found so fascinating about Symbiotic. One reason they did fall is because they diluted the shareholder by like 5% at $87 a share. But I guess that was kind of smart because it's $48 a share now. They did it when it was at all-time highs. I don't mind them doing that. So anyway, that's a bit of that's like one of the best robotic stocks if you're actually looking for a real one. Like stay away from like, I used to get this one all the time, like Rich Tech Robotics. Like, look, Symbiotic is on a dip. This one's on a dip. If I was going to buy one on a dip, definitely do Symbiotic. Like here's Rich Tech Robotics. They're getting sued right now by shareholders and they have no revenue. I mean, the revenue is literally $1 million a quarter. So yeah, I would not buy RR. All right. Hey, thanks again, Rand, for all those gifts there. He said BBAI. Look, too bad. Unfortunately, I have nothing really good to say about this stock. They're just a micro cap. And they had some disappointing Army contract revenue news. Like, look at this. You read the number one line. Revenue dropped significantly due to lower volumes on U.S. Army programs. So if we go to their revenue this quarter, they actually missed, I believe. Yeah, analysts expected 33 mil of revenue. They only did 27 mil of revenue. And remember, this whole company, they're a small cap, or actually not that small. They were $2 billion. So the whole company is worth $2 billion. And it's just kind of unfortunate because the growth is kind of negative. Growth is negative 20% year over year. They're losing money. Like this was actually the most amount of money they've ever lost, basically in one quarter. So nothing's just blowing me away here. Yeah, I wish, because that one's kind of popular. Like I just I don't know. Thanks for all those gifts that you left me, Rand. If you have another stock you may look at, let me know. But I just try and keep it real. Like, yeah, I don't see too much hype around that name. Ooh, can you do ADMA Biotech? ADMA Bio. I'm guessing it's this company right here. They're actually on my watch list. So, hey, there must have been something that impressed me. They're worth $3.6 billion. Actually, they're very cheap on the right. They're at a 15 forward PE. Yeah, hey, Kurar. It's in the Linktree bio, first link there. But yeah, they're at a 15 forward PE. So that's what's interesting here. ADMA Biomanufacturing. Yeah. So this stock really has good growth. If we look at this on an annual revenue basis, in 2020, the full year, the revenue was 36 million. But for the full year 2025, it was 500 million. And are they profitable on that? Let's see. Yeah, they are. So, okay, this one actually is good. So we scroll up to the revenue. This is what you want to see. Revenue just hits a new record every quarter. And it's not just the revenue, but the profits. Look at that. This quarter, they made 62 million. And they have a really good balance sheet. No net debt. Making good net income every quarter. Yeah, so that's why the forward PE is a 15. I'm actually going to re-put them kind of toward the top of my watches. This is kind of again, you got to be careful. It's a biotech company, but of all the biotech companies, I want to buy the one that has that sort of growth with that sort of great net income too. Patented immunotechnology, vertically integrated manufacturing. So, announced 125 million share buyback program. Yeah, they can easily afford to do 125 million share buybacks, especially at 15 times next year's net income. We can see the revenue expectations are up and to the right. Net income expectations are up and to the right. It's going to go from 34 to 55 mil. That's over, 220 mil a year annualized. So yeah, they really are at a 15 forward PE. Congrats if you own that one. Hey, what's up, Glenn? He says, happy Sunday from Spain. Yo, very nice to meet you, man. What are your thoughts on NU? Let's check it out. After some research, I ended up making a demo account. Hey, what's up, Nini? Good to see you. So this is actually a nichier company. This is a crypto bank out of Brazil. I think you'll find this one pretty interesting. And I like this one because of their good fundamentals. They're actually applying for a U.S. banking charter right now. Morgan Stanley raises NU price target to $21, projects $100 billion valuation by 2026. Well, what's the company worth today? The company today is worth $70 billion. So that would be a good 30% plus upside. But here's why I absolutely love this stock. So again, this is a crypto bank out of Brazil. If we go to where the revenue comes from, again, 92% of the revenue comes from just Brazil, Mexico. So yeah, pretty much a pure South American kind of crypto play. But that's where crypto for transactional purposes are popular because the currency is not so good down there. So if we zoom out, again, these are stocks I want to own. With good growth. The revenue's up 56% to 4.69 billion. Out of this 4.69 billion of revenue, they netted, after paying taxes, $894 million. This is their real after-tax net income. I can't believe it, but it's real. Like, they really do make, at this growth, they like 700 mil of real after-tax net income a quarter. That's why they're a $70 billion company. And the forward multiple, what's the forward multiple? Yeah, they only trade at 17 times next year's net income. So that's why, like, if I wanted exposure to crypto, this could be a way to get exposure to crypto, like via a stock, and then potentially be more growthy. I just love their net income numbers. And look at the net income supposed to hit 992 million in 2 quarters. That's going to be $1 billion a quarter, $4 billion a year. And at $100 billion market cap, that's like a 4% earnings yield. Yeah, I could totally agree with or Morgan Stanley's $100 billion market cap valuation by 2026. I wouldn't be shocked. And that would only be like a 22 multiple. So NU Holdings, great growth there. All right. Someone said, what terminal or what are you using here? Yeah, again, hey, this is a brokerage I'm on right here. If you want to get this app, I'm on. It's actually in the link tree in my bio there, the very first link. Or if you're on YouTube, it's a link in the description, first link there. It's a broker or a affiliate link, full disclosure. So if you go and like deposit $100, I think we'll both get like a free stock. But yeah, free brokerage. My favorite to analyze apps. Or all these apps are all in the link tree in my bio. I like Robinhood, Webull, Moomoo. I just use this one the most because they're the most useful. They're free, best analysis tools, free, nice little APY. Okay. Ooh, what's up, Looney? Shout out to member Looney. He said BlackRock. Yeah, private equity is getting crushed right now. And like if you look at the BDCs, banks, they're getting crushed right now. But out of all the stocks to buy during this credit crisis, we could say, like BlackRock is actually limiting withdrawals from their private equity fund. Let's see. Yeah, look at this. BlackRock literally caps withdrawals from their $26 billion lending, or basically BDC. After redemption, people are actually, someone tried to withdraw $620 million from the $26 billion thing, or like nearly 10% of all the assets. And now BlackRock is like, yeah, we're not allowing anyone to withdraw from our fund anymore, which is not good. BlackRock negotiates acquisition of 41 CK ports. Okay, anyway, BlackRock's one of my favorite ones to buy because of all their other businesses. So obviously their private equity business is their largest one at 33%, but they also have this alternatives business, which is their crypto ETFs. Look at the year-over-year growth rate from full year 2024 to 2025. It grew 71% in 1 year. How did this alternatives business grow so much? Well, that's because they created their own IBIT ETF and also some Ethereum ETF. So that's why this one has seen, like last quarter grew 130 or 120%. This quarter grew 35. This has seen a lot of growth. And that's one business I'm really bullish on. And they have so many other businesses too, like technology subscription revenue. Look at that. It's at a record this quarter. This is reoccurring, up 25% year over year, record quarterly revenue. Investment advisory performance fees. So based off how good their fund does, they collect fees, and that's up 67% year over year. And if we look at the forward PE, BlackRock only trades at 17 times next year's net income. It's a good dividend growth play too, because if you buy the stock even right now, you're getting 2.2% of your money back just in a qualified dividend every year. 17 forward PE, and here's their actual net income down here. They had a slight one-time adjustment this quarter. It says the net income fell 25%. The actual core business, the profits actually grew 9% to a record quarterly profits. It's actually never been higher than $2.23 billion. If we zoom out, this was a record profitable quarter, excluding that one-time adjustment. Sales were up 23%. The margins did slightly compress, I believe. Yeah, gross margins fell 7%, so that might be another reason they fell. But anyway, I think we're definitely in oversold territory, where the risk reward is starting to look very fair to start buying at a 17 forward PE for BlackRock. You know, they manage like every asset, and they have all those popular ETFs. Like if you click on any stock, like if you just go to Amazon, you go to company, you go to shareholders, usually, yeah, BlackRock and their ETFs are almost like always one of the largest shareholders. They're one of the biggest asset managers with like 2 trillion assets under management. Hey, what's up? He says, hope all is good. Can you look at Ondas? Yeah, so this is a smaller, like, I think it's a drone play. Ooh, sorry if I'm missing some stocks here. There's a lot of good stocks I want to get to. I see GE, Veranova, and Credo. My bad if I'm missing some stocks here. Like I see American Express and Cisco. We'll get to those. So, and we're going to be live for another 2 hours. So what's up, y'all? If you wanted the follow button, we stream every Sunday, this exact same time. We stream every day. I sell nothing. I have no course book, WhatsApp coach. I literally sell absolutely nothing. Just on here, give my opinion. So not financial advice. So here's Ondas Holdings. I think this one's had so much momentum because there's a lot of future growth expected. Let me just check out the future growth expectations. Yeah, exactly. So if we scroll out on the revenue right now, this quarter was a record 10, or if we look on the very right, they did 10.10 million of revenue. It's never been higher than that before. If we zoom out, as we can see, it's never been higher than 10 million of revenue before. And if we go to what analysts are expecting, literally next quarter, they're expecting 27 million of revenue. And then the quarter after, 28 million. Oh, dude. Oh, man. Dude, that's not cool. Try not to spam like that. All right, we're good. Okay, but yeah, anyway, yeah, if we look right here, the revenue's supposed to literally hit 27 million next quarter. They're still supposed to lose money, but it's really just the top line growth that's leading to this momentum. So as long as they beat on these revenue expectations, the stock will probably just continue to climb higher. Like, look, revenue's literally going from 4 million to 28 million. So this is like next quarter specifically, like there's so much focused on next quarter's earnings because it's literally like the transitional quarter where they go from basically 10 mil of revenue to record 30 mil of revenue a quarter. So really watch these next couple quarters. So hopefully that was somewhat helpful there. Ondas Autonomous Systems. Is it like a LiDAR play? Drone, yeah, drone concept stock. So some sort of drone play. I would be careful though. Just keep that one as a small allocation. But you're really watching that top line growth. Speaking of American Express, you know who owns a boatload of American Express? Is actually the homie Warren Buffett. So if we go to Buffett's portfolio right here, a lot of people know him for Apple because Apple is 19% of his portfolio, but American Express is actually his second largest holding. They own 15% of all, or 15% of his entire portfolio is just in American Express. And this one has really started to tank. And part of this is actually because of Robinhood. Robinhood released a card that's very competitive to their American Express premium card. So Robinhood launches a $695 platinum card, and analysts are saying this is an incremental negative for American Express, citing potential vulnerability as 75% of new Amex Platinum and Gold customers are younger demographics, aligning with Robinhood's user base. And what does Robinhood's card do? For $695 annual fee, it's really like a traveler's card. You get 10% cash back on hotels and rental cars, 5% on flights and dining, plus priority pass lounge access. So anyway, that's one reason. It's not some huge valuation crossing thesis here with that card news. So they're really pretty cheap now. On the right, they're at a 17 forward PE. It's a good dividend growth stock. If you buy the stock right now, you're getting well over 1.1% of your money back just in a qualified dividend every year. They raise their dividend very fast, faster than inflation every year. So yeah, the forward PE is lower than their current PE, so they're expected to grow their net income, which is pretty good. And they're also, I think, internationally, yeah, they do have some international exposure like Europe, Asia, and stuff. But yeah, 77% of the revenue comes from the US. And check out their bottom line. This is like the most impressive part. They easily make always like 2 to 3 billion of after-tax net income. Like, look, so they're making on average, we'll call it 2.7 billion of net income a quarter. What is American Express doing with 2.7 billion net income a quarter? Well, mainly my favorite part, well, they pay dividends. Look at that. The dividend that they pay, the over 1% dividend, only costs 580 million. So we know there's going to be a lot of more room for their dividend to grow. But since they have so much leftover money, they're literally spending $1 billion to $2 billion a quarter on share buybacks. And if you're wondering, what does share buybacks do for you as a shareholder? Well, check this out. The net income grew by 13, but the net income per share, the EPS, oops, it's on cumulative. So look, the net income grew by 13, but the net income per share grew by over 16. Again, the EPS growth rate and the net income growth rate should always be the exact same. But since they bought back 3% of the whole company, the EPS grows 3% faster. Whenever they buy back their own shares, it gives you, more ownership in the company, makes the EPS go higher, makes the PE ratio go down, makes the dividend cost less. So in short, buybacks literally like force the stock to go up. So I love when companies do share buybacks, and they're just a cash generating machine that's just shareholder friendly. All right. All right. Thermon said PRSO. What is PRSO? Oh, and I sell Meta. Yeah, let's do Meta after this. HIMS. Yeah, HIMS had some lawsuit ending news. Actually, we're not really going to cover this stock right here. If you look in the top right, we just really don't cover these kind of stocks. They're only worth $18 million. So the whole company's worth $18 million because of all the reverse splits. This used to be a $175,000 stock. So yeah, this is like real bankruptcy risk here. We probably won't even cover it. Yeah. So anyway, this is just some $18 million microcap momentum stock that went up 100%. Be so careful with those. There's no fundamentals to really judge there. Just a pure swing trade, day trade kind of stock there. So what was that? Oh yeah, Meta, dude, I'm a big shareholder of Meta, full disclosure. They're one of my favorite stocks to buy right now because the valuation is fair. They're in my dividend only portfolio. We were down bad this past week. See, we're down 3.4% the past week. Year to date, we're down, we're not down too much, only 1.5% year to date, but we do own 5.1 shares of Meta. I'm always a fan of buying fractional shares. The other day, I bought 0.1 shares of Meta with my extra cash. But yeah, let me judge Meta. Even at right now's price, they are undervalued in my opinion. For the behemoth Mag 7 Meta, only at a 21 forward PE, which means they're only trading at 21 times next year's net income. I think there's so much like upside potential here. But one thing being questioned on Meta is how much they're spending on AI. If we go down here, their cash from investing activity spend, they just projected they're going to be spending $40 billion a quarter for the next 4 quarters in a row. So that's the highest CapEx ever. And this is really keeping Wall Street up at night, is if they're going to get a real return on this spend. I do like what Meta's doing. They have to spend, they can't be out innovated by AI. But yeah, they plan $135 billion in CapEx for just 2026. And they just signed multi-billion-dollar chip deals with Google, Meta, AMD. Meta develops custom AI chips. Really? You see, everyone's working on their own TPUs right now. Meta just bought a bunch of TPUs. But anyway, Meta literally, their main business, right? Like, I love what they're doing with their Meta Ray-Ban glasses, if anyone's heard of those before. But Meta, with their family of apps between Facebook, Messenger, WhatsApp, Threads. They literally have Instagram 3.54 billion daily active users. So pretty much half the world is on one of their apps a day. And another kind of conspiracy is China isn't allowed on their apps. So pretty much this is more than half of the accessible world is on one of their apps every day. I guess it makes sense because their numbers prove it. They did 59 billion in revenue, and on that they netted 22 billion. Again, last quarter we're looking at the forward PE because it says they only made 2.7 billion last quarter. It was a total one-time adjustment. We can see the operating profit. It was their normal 20 billion last quarter. They had a one-time tax charge. That's why I like to blend the operating profit with the net income because it was a total one-time adjustment, and that's hurting their current PE ratio. So that's why we look at the forward multiple. Meta's a steal of a deal, and there's also some nice tailwinds. They're just now, has anyone heard of Threads before? I actually found myself going on Threads sometimes, like when Instagram recommends it. They're actually now putting ads on Threads, and they're introducing ads to WhatsApp. After they acquired WhatsApp, and their original slogan was no ads, no gimmicks ever. But anyway, Meta's introducing ads to WhatsApp and Threads, and that's going to be a nice earnings tailwind for Meta, plus the AI thesis. So yeah, anyway, Meta's a great never steal at a 21 forward PE. I don't think they're expensive at that 21 forward PE. Actually, all the Mag 7 is cheap. That's why we're not in a bubble. Microsoft is just as cheap. Look at this. Microsoft's trading at 23 times next year's earnings. Google's at 25. I think Amazon's at 26. What apps are you using? Yeah, hey, all these apps I'm using are all in the link tree in my bio there. I'm on Robinhood, Webull, and Moomoo. These are the three brokerages I use. If you're wondering what's the best brokerage, if you want to get interested in investing, I like this app right here. It's the very first link in the link tree in my bio. Oh, by the way, you can just type them into the app store like Robinhood, Webull, Moomoo. But if you want to use my affiliate link, they're all in the link tree in my bio. This is my favorite app. Costs nothing. It's free. Literally best analysis tools. So yeah. All right. So let's see here. Oh, actually, speaking of this app I'm on right now is publicly traded. So I own all these apps. I own Webull stock, I own Robinhood stock, and I own Moomoo stock. So if you're wondering, yeah, someone just said this stock right here. So this app I'm on right now, Moomoo, this is their stock right here, publicly traded. And it's good to see that the app I'm actually using, if we're going to trust our assets with them, again, even if they go bankrupt through FDIC insured for $250K, but it's good to see that the brokerage I'm actually using is printing money. This company, the app I'm on right now, made 413 million in net income this quarter, mainly from interest income. Check this out. This is what's one of the favorite things about this app. Their interest income's up 80% year over year. So if you look in the middle of my screen right now, they give anyone literally for free a 3.35% APY on your idle cash. What they do is they earn like a 4% APY on your idle cash, and then they just give you 3.35% of it. And you don't care because it's just on your idle cash. It wasn't going to earn anything anyway. Anyway, yeah, Futu, this app I'm on, I am a shareholder of this app. I just bought their stock the other day. They're only trading at 11 times forward PE. They're cheaper than Webull and Robinhood stock. So yeah. Where's my Futu? Yeah, there's my Futu position. I got 14 shares of them. We're up 8%. I own Robinhood. I own all the fintechs. I love this industry. I own Robinhood, SoFi, Dave, Webull, Futu, Robinhood. I love all this. So yeah. Okay, anyway, let's just go look at some more y'all stocks here. Samsung. What's the ticker? I don't think I can view Samsung, unfortunately. Oh yeah, Cisco. He said SYSCO. There's two different Ciscos. Wait, SYSCO. Okay, so yeah, this is the food delivery company. I think they're trying to acquire Restaurant Depot. We can't find that news, but basically 80% of all small, medium-sized owned restaurants literally use them. Hugest market share for restaurants right now for food delivery, just random stuff like bulk ketchup and supplies like that. So yeah, they're trading at 18 times forward PE. The bad part is I don't know if you're going to crazy outperform the tech-heavy S&P 500 owning this company. Technically, the stock is the same price that it was in 2019, but the best part is probably the dividend because they really do have a safe 2.5% yield. So no matter what, you're getting 2.5% of your money back just in a qualified dividend every year. 18 forward PE, U.S. food operations. Let's see their net income. So yeah, this might be why. So if we look at the revenue, it's kind of low single digits, the growth, 3% growth, 3%, 2.8. But if we look at the net income, the profits, they're actually negative year over year. So this kind of makes sense because labor cost and commodity inflation right now is kind of tough. So yeah, look at that. Their net margin fell 7%, or their margins are just down across the board. Actually, let me zoom out to their net margins. So yeah, I guess they kind of used to have an over 2% net margin. Anyway, it's not the end of the world here. Actually, I like what they're doing with this Restaurant Depot acquisition. I just don't know if that's going to outperform like crazy. It kind of just depends on how restaurants do. And restaurants aren't doing too well. I mean, if we just look at like a Wendy's right now, RIP Wendy's, this stock is pretty much at an all-time low. They're lower than they were in their 1997 IPO somehow. RIP Wendy's. Same with Jack in the Box. It's not just like a Wendy's problem. Jack in the Box, they're the same price as they were back in 2001. Krispy Kreme is the lowest they've ever been. Oh, what's CRBL's? Is that their ticker symbol? Oh, or is it CBRL? Oh yeah, Cracker Barrel. Look at this kind of restaurant. Dang, they're the same prices they were when they IPO'd in 1997. So a lot of these restaurants are struggling. I really like McDonald's. Actually, this isn't really even a restaurant. It's really a real estate royalty company, but McDonald's. There's a reason. If you look at Wendy's, Wendy's is at an all-time low. Cracker Barrel's at an all-time low. McDonald's just hit an all-time high. Why is that when they're also a restaurant? Because they're really a real estate royalty company. You go spend $100 at any McDonald's, they keep 4% of your entire transaction as a royalty, and 80% of the stores are franchised. They're collecting rented royalties back from every store. It makes a great business model with incredible margins, that royalty stream. So they have like 30% net margins. It's because they're not really a restaurant. Okay, let's look at some other one here. Ooh, yeah, Toast. Actually, that's a restaurant POS company. I used to own this stock, actually. This is a great software name. So they do the point of sale system. If you ever go to like a food truck and they're asked, you see that they have like this weird looking iPad that's like, would you like to leave a 10, 15, or 1,000,000% tip? Well, Toast is the one that makes those machines. And they have some real data to support you buying this. Because with those tip machines and whatever, the average ticket price does go up. I want to pull up their website if it would please load for us. But yeah, they're a point of sale system. I don't know if if the website will load for us because I don't think that's the actual link to their main website. But anyway, I love their growth. It's really impressive. We just zoom out to the revenue right here. Like this is what you want to see for a growth stock. Every quarter, the revenue just hits a new record. So the revenue's up 22, after grew 29, after grew 35, after grew 55. So really impressive top line growth, and not just top line growth, but bottom line growth. They're the most profitable they've ever been. A year ago, it was a tough buy when they were losing net income every quarter. But no, this is a company that prints real net income right now. They have a great subscription model. They made over 100 mil in net income just this quarter, a 200% increase. They actually have no net debt too. That's another thing I like about Toast is their fortress balance sheet. I really wanted to pull up their website because look at how they beat on expectations. Analysts expected 72, they did 101, and the expectations are just up and to the right. I'll try one more time clicking their website because I think it's just toast.com. Yeah, okay, anyway. I've made a few YouTube videos about them actually. Next up, Jose said QQQ. Yeah, this is just your NASDAQ 100 ETF. Basically, it owns 100 kind of tech companies. Its largest holdings are, what's popular by market cap: Nvidia, Apple, Microsoft. So basically, QQQ, this is an ETF you buy that should give you 8 to 10% of your money back every year. It's like an S&P 500 alternative that historically does better than the S&P 500 because they're a slight bit more tech heavy than the S&P. Yeah, no complaints about QQQ. Yeah, hey, lighting the world. Thanks for that one, man. Yeah, Toast is pretty cool. All right, next up, let's see, Honda and SoFi. Actually, yeah, SoFi, I am a shareholder of SoFi. This is one of my favorite growth stocks right now. Actually, I am a shareholder of SoFi, so I am biased, full disclosure, but I own them for a reason because they're so great. And if you wanted SoFi as 5% of your portfolio, you don't make it 5% of your portfolio today, but I think you might go ahead and make it like 1% of your portfolio if you find it interesting because the valuation is really cheap on the right on a forward basis. Because this is a pure growth stock. You always look at the forward multiple. They're only trading at 28 times next year's PE. It's a huge increase from its current PE of a 48. They look super expensive at 48 PE, but the forward PE is a 28. So that's why I think they're attractive. And the metric you want to focus on for SoFi is this right here, their financial services. This is the part of the business that has been beating like crazy on analyst expectations. No analyst expected this sort of growth, and this growth is being rewarded via a high multiple. So the revenue's up 80% year over year, after grew 85, after grew 114, after grew 290. They're just on a streak of growth. Like it hits a new record every year, every quarter. No analyst expected that. And we can actually see the analyst expectations down here. It's the orange line. For the past 3 quarters in a row, they beat on revenue every quarter. And they beat on net income every quarter. They expected 152. They did 172. And check it out, in 2 quarters, the net income is supposed to go from 97 to 197 million. So that's why I think people are really starting to take SoFi seriously. They're not just some junky momentum stock. Like, no, they have real improving fundamentals. Revenue just hits a record every quarter. They're making well over 100 to 150 million net income a quarter, which they're projected to do. We're supposed to hit 200 million net income in 2 quarters. So JP Morgan's really bullish on this one too. I think they took like a stake in them. Oh yeah, and the SoFi CEO Anthony Noto purchases 1 million of the company's shares. He just buys the shares. SoFi launches SoFi USD stablecoin. They're the first U.S. Nationally chartered bank to issue a stablecoin. So yeah, they have their own banking charter. They got it through a loophole back in 2021. That's now patched because of them. They're genius. So hey, FNI6, appreciate that. Love that I found this. I appreciate you, man. I try to stream every day. If y'all wanted the follow button, I just oh, someone said hymns. There's some news. I actually have a lot of news to kind of talk about this stock. This is a whole story. So they're up 40% on Friday. There's a lot of news. I'll kind of go quick here. So basically, this is a healthcare company that sells a bunch of prescriptions on their website. It's like a subscription company. And a couple months ago, like a year ago, they were selling Ozempic and Wegovy on their website. So Novo Nordisk sold Ozempic and Wegovy on Hims and Hers website. But then a couple out of nowhere right here, or actually it was a little bit before, this day, Novo Nordisk abruptly ends their partnership. So they take off their weight loss prescriptions from Hims and Hers. So Hims and Hers no longer sells any weight loss prescriptions, and that was their highest margin segment. So they're a little bit upset about that. So they make their own knockoff Ozempic and they start selling their own knockoff Ozempic. And Novo Nordisk gets super mad about them. They sue the life out of them and they report them to the SEC and stuff. And that's why they tanked this day. There was no earnings this day. The reason they tanked 50% that week is because of that lawsuit news. But why are they up 40% after hours? You can't make this up. Novo Nordisk and Hims and Hers to end their legal dispute, and they're actually forming a partnership on an obesity prescription. So that is great sentiment for Hims and Hers, because if we zoom out, you know, the thing that has been leading to all their growth in the past and their high margin, like this was their highest margin, the highest margin selling item was their weight loss stuff. It's been hurting their margins that it's been gone for the past couple months, but it's good that it's back now. I think they have like 2.3 million premium subscribers paying them every month. I know they also just acquired like Eucalyptus Pharmaceuticals. They're getting into testosterone products. So yeah, they have great top line growth. And they're making net income every quarter, but the margins did just collapse. Like if we go to the gross margins, because they no longer sold it, look, the gross margins are down 7 after they fell 7. Net margins are down 40% year over year, but it should be an interesting future. See what happens next. And also, I can kind of see why Novo Nordisk wanted to end the legal dispute, because they're losing the weight loss prescription war to Eli Lilly. So Novo Nordisk right here is the company that owns Ozempic, and Wegovy. They're also, their stock is almost done worse than Novo Nordisk. They're like 80% off their all-time high, unfortunately. And that's because they lose a lot of their they lose their exclusivity on Ozempic in a couple years, like in 2028 in the US and like 2030 in China and Europe. So, but yeah, 93% of this revenue is their obesity products care. I don't know. I guess we'll just see what happens. Do you use SoFi? Actually, I do not use SoFi, but I do have some SoFi shares. So, short squeeze incoming. Isaiah said, hey, what's up, Isaiah? Thoughts on CoreWeave versus Nebius long-term? Long-term, neither of those I like super long-term, because again, if you're wondering what is Nebius, again, these are both NVIDIA holdings. So if we go to NVIDIA's portfolio, they own a lot of CoreWeave. They own a lot of Nebius. Why does NVIDIA own a bunch of their stocks? Because they're giving them so much money. NVIDIA is taking stakes into these companies and giving them money just so that CoreWeave and Nebius can just buy a boatload of NVIDIA chips. So the long-term thesis here isn't great, because what does this company do? Nothing proprietary. They literally, all they do is own GPUs in a data center. They just own a boatload of GPUs. And right now, CoreWeave is taking out debt and buying bulk GPUs, and they're undercutting all their competitors' pricing. So here's the weird part. I don't know how sustainable this business model is, because, well, right now, GPUs are in such demand because from cloud companies like Microsoft. Microsoft signed a $20 billion deal with Nebius to rent out the capacity of their GPUs. So they have great top-line growth. Like, check this out. They did $1.57 billion in revenue, a record this quarter. And look at what analysts are expecting. Revenue is going to go to $2.7 billion in 2 quarters. Incredible. The revenue is going to double. So revenue is going to double. But here's the thing. You'd think this would be some profitable growth, but no, because their business model, they're actually going to double their losses. So they're going from 250 million loss to over 566 million net income loss in 2 quarters. Like, they're expected to just lose more and more net income despite revenue doubling. So it's not profitable growth. So again, the net margin end game isn't great, and I'd much rather own Nebius if I had to pick one, but they have a big backlog. Yeah, like they have a $66 billion backlog, CoreWeave does, but it's just a tough long-term thesis there. They should do good through the end of the decade, but yeah. What's next? Ooh, what app using to view these info? Yeah, if you want to get this app I'm on, it's actually a brokerage where you buy stocks on. It's the very first link in the link tree in my bio there. Brokerage called Moomoo. It's an affiliate link, so if you go and like deposit $100, we'll both get like a free stock. It's free brokerage. Oh, Altria. This is a pure dividend play. If you're looking to maximize your dividend income, check out MO right here. And I say you buy this to maximize your income because historically you don't get much stock price appreciation. This stock is the same price that it was in 2016. So actually, dang, 2016 was a decade ago. So technically, this stock is the same stock price that it was a decade ago. But what you do get every year is a good dividend, a 6.25% qualified dividend. And it says the payout ratio is 100%. I believe it's not actually. I believe they have a safer like 70% payout ratio. So yeah, look how much the net income is supposed to grow. So the forward PE is only a 12. So yeah, they probably have like a 70% payout ratio. But yeah, they're in this kind of slow decline industry. I can't say on TikTok what this is, but I think you can kind of see the industry in the very middle here, these kind of products. I can't talk about it on TikTok. But anyway, if we go to the revenue, like you can kind of see, it's kind of just low single digit declines, like the sales, the revenue, the lifeblood of the company. Revenue's down 2% after, like it's just all negative revenue declines just for look, even since 2021, there's never been a single positive revenue growth quarter. So it's just like this industry that's kind of being, like, I can understand why the stock is the same price that it was a decade ago, but let me show you how safe the dividend is. And they did have a one-time adjustment. So this quarter, they made $2.9 billion before tax. It says the after tax was only $1.1 billion. They actually made like $1.9 billion. So it was a one-time adjustment. So let's go see how much the dividend cost. So the dividend that they pay only cost $1.79 billion. So as long as they make over $1.79 billion a quarter, they can afford the dividend. And most quarters, like excluding those little adjustments that they have, they can pretty much cover the dividend. But again, you buy that to maximize your income. I don't know if that's really going to outperform the tech-heavy S&P 500. PM is actually growing. This was a split off from Mo. They've actually been doing much better. They're at an all-time high because of I don't even know if I could say this. They bought a company called Zen, like 2022 free business. And it's been growing way faster than analysts thought, specifically the Zen brand. So PM's another one with a high yield. They have like a 3.3% dividend yield. If you just like that whole industry. Ooh, Nick said Visa and Jimbo said VRT. Let me do VRT. And again, sorry if I'm missing some stocks here. This is like a data center infrastructure play. Hey, Clips Galore, I appreciate you, man. ServiceNow is the strongest company. Yeah, ServiceNow definitely fell way more on earnings than they should. Oh no, hold up here. Okay. Dang, it's still bad. Give me a minute here. Sorry. My Wi-Fi just like tanked for some reason. The kilobytes just went to like 300. Okay. I'll just wait for this. Okay, we're fully back. Okay, it says 25,000. Okay, we should be fully back now. No more lag. Sorry if it lagged for a second. We're good. So here's Vertiv Holdings. They actually just got added into the S&P 500 on Friday. So congrats if you own this company. Let's see if we can find that news. Yeah, Vertiv Holdings to join the S&P 500, replacing Paycom Software. So yeah, this is a data center infrastructure stock. Actually, next to my house, there's a huge Vertiv facility. I drive past it all the time. So they're much cheaper on a forward basis. Like the current PE is a 70, but the forward PE is a 42. So that's much cheaper. They're having like this year's like 40-50% EPS growth. So you really do like a peg ratio to see how they're actually valued, because they're not crazy expensive, but still, I would not pay their current valuation. They're, especially after they're up 5% after being the S&P 500. But yeah, when you get into the S&P 500, so many passive indexes and passive flows now go into your stock. But yeah, if we go to the revenue on this company, the revenue grew 22%. That's great growth. If we zoom out, yeah, a record quarter revenue. So record quarterly. So I can see why the stock has done so well. It's not just momentum setting the stock higher. It's actually their real fundamentals growing. So the revenue's up 22 and the profits are up by, or actually I should look at net income. Yeah, look at the net income. It's up by 203. If we zoom out to the net income, there's never been a quarter in history where the net income has been higher than it was this quarter. So record sales, record net income. What about the free cash flow? Look at that free cash flow. 880 mil of free cash flow, never even been close to it before. So great numbers here. I think they do like cooling. They mainly focus on like data center cooling. It also switchgear products, thermal management, rack systems, modular solutions. Pretty cool stock here. Just like a data center beneficiary play. Let's see here. Someone said, I hate that you're anti-Corey. You know, it's just the net income and like proprietary moat issue. Like there's just no moat around CoreWeave and there's no profits. The net in-game net margin is just not there. That's the only bad part about CoreWeave. Like I love the top line growth. Like I'll give them that. They have great top line growth, but it's just like they literally all they do is just own GPUs. It's just basically a data center. Like it's kind of like Iris Energy. Like you said, also what about our Iris Energy? Yeah, this is another very similar company to CoreWeave and these other companies. But if you didn't know, Iris Energy, they're another one that literally all this company does are just like CoreWeave. They just own a bunch of GPUs in a data center. And still right now, their GPUs are used for Bitcoin mining. 90% of the revenue is their Bitcoin mining revenue. But right now they're getting huge deals where their other companies are asking if they could rent out the capacity of their GPUs for cloud HPC instead of just them using their GPUs to mine Bitcoin and then get a higher return. Oh yeah, hey, DJ, thanks so much for that gift there. He says LYB and BAK are petrochemical plays. Oh yeah, let's do LYB right here. So, unfortunately, this stock is the same price that it was in 2012. Let me check out the other stock, BAK. Because usually these commodity stocks, yeah, like see, this one you buy for the exposure to the commodity, but you don't really expect to outperform the S&P. Like we just looked at LYB, same stock as or same price as they were in 2012. BAK is the same price as they were back in 2000, the year 2000. But these are really cyclical plays. You know, you want to like catch them on their swing up and down. Like, yeah, I bet with the new war fear, my Wi-Fi today just is being a problem. Okay. Sorry, it lagged again. My Wi-Fi just like completely went out and it's still lagging. Sorry again for the lag. This like never happened, so I apologize. That is not good. Someone said, I remember your profit and loss when it was under 20K. Did you consolidate accounts? Was 2025 your year? Yeah, basically this, dang, and my screen just disconnected too. Oh man, yo, everything's just not going my way today. That's not good. Okay. Did my mic? I'm just having the worst day ever. Okay. We're working now. The whole my microphone application crashed on me. So we're fully back though. Let's keep going. Okay. APP stock. Let's do AppLovin because this is actually my second most recent purchase. Let's go over AppLovin. So if I go to we're fully back now. Sorry about that lag. Hopefully it won't happen again. But yeah, AppLovin right here. This is my most recent purchase. These are actually all my most recent purchases in order. So my most recent purchase is AppLovin. Then it was AbbVie, CHRW, Southern Company, Iron Mountain. So AppLovin, we literally bought this stock a week ago. This is what's fascinating. There's my buy order right there. We bought 1.5 shares at $382, and it's already up to $500 a share. When I saw the software dip, out of all the software stocks to buy on the dip, I chose to buy AppLovin because I couldn't believe how, like, this is the most quality software stock, like, at the cheapest valuation at the time. So if we looked on the right now, they're a little expensive. Like, I bought them at like a 28 forward PE, but currently they're at a 32 forward PE. So they're currently trading at 32 times forward net income. Here's why I think that's super fair. AppLovin, no other company grows at this rate. If we zoom out on their net income literally hits a new record every year, every quarter. They did 1.1 billion of real after-tax. That was after-tax net income. After they paid 200 mil of taxes, they made 1.1 billion in net income. And they're not done there, even according to the analyst. Next quarter, analysts are expecting 1.18 billion and then 1.25 billion in net income. Same with revenue. Revenue's up and to the right, net income's up and to the right. And this is really a margin expansion play. Look at their total revenue. The total revenue was 1.66, and on this 1.66 bill of revenue, the net income was 1.1 billion. Again, after taxes. So literally their net margin is better than Nvidia. They have a 66% net margin. This is a gaming advertising stock. I've looked at Roblox, Unity. I would not buy either of those stocks. I definitely buy AppLovin if I had to pick the best one. And they're also in talks right now to potentially partner with OpenAI. I wonder if we can find that news down here. Probably not. But OpenAI is looking to almost partner with AppLovin for advertising revenue. It's very cool. So yeah, AppLovin, they're a little expensive at a 32 forward PE, but it's certainly a great stock to put on the watch list. All right, PPTA. What was this stock right here? Um, yeah, hey, Cybul. Yeah, basically the reason my portfolio here, I'll show you my 1 year performance. This has been my best performing portfolio. We're up 25% year to date. And yeah, look at this over the past year. And this is on a return money weighted. We're up 134% exactly from 1 year ago. Again, there was the April dip. You know, we were doing just as bad during April, but yeah, now we're up just from 1 year ago, $20,000. And mainly that's from like all these great stocks right here. Comfort Systems, I bought them almost exactly a year ago. We're up 250. Powell Industries, we bought 2 years ago. We're up 500. Coca-Cola Consolidated, this has been another huge performer. We bought this stock less than a year ago, and we're almost up 80% now. And, you know, these boring Coca-Cola, like consolidated boring stocks have been doing good. The defensive names almost. Let's get to PPTA. I saw there's a lot of stocks I want to get to. Let's go. Oh, I see Reddit. Yo, I love Reddit. I am a shareholder of Reddit. That's another great growth company. A lot of people think Reddit's a meme stock, but they're a great company. Hey, what up, Lucas? We'll look at Klarna, and some of these other ones. You got to check out Viasat. Yeah, if you have a stock you want to look at, please give me the ticker symbol, and we'll definitely check it out. I see EOSE. We'll get to those. So here's Perpetua Resources. They've done great. I'm assuming because of like just the war fears right now. Let's see. So they don't have a PE ratio, so they're not making any net income yet. Okay. Phone, please. Dude, my Wi-Fi is just like extra. Dang. It's like never happens. I don't even know what to do anymore. By the way, if you wanted the follow button, we stream every day. Like I never have Wi-Fi problems like this, man. Damn. It just disconnected again. Well, thank you, Wi-Fi. By the way, yeah, if y'all wanted the follow button, we stream every day. I sell nothing. I have no course, book, WhatsApp. I don't coach. Come on. Like, I'm on the Wi-Fi. Okay, well, it just wants to be a problem for me. Anyway, here's Perpetua Resources. The stock's done great. It's nearly at an all-time high. They don't have a current valuation. So, they just have no revenue. So if we go to the revenue right here, they're a startup. So if we click on revenue, it says no data because they've never sold anything. They've never sold a product or a service. So yeah, we go to revenue, no data because they've never sold anything. But luckily, they have a fortress of a balance sheet. Look at that. They literally have no liabilities, no debt, and so many assets. So this must be like an in development, rare earth mineral stock. Like maybe they own a gold mine. Yeah, so they own the restoration and operation of the Stibnite Gold Project in Idaho in the USA. So yeah, it looks like they're a gold company. They're probably just following the commodity of gold. That makes more sense. So they're not really an oil and gas stock. They're a pseudo gold play. I worked for Iron Mountain. You have a position? Yeah, Iron Mountain, they have a few businesses. This is actually a REIT right here, a higher yielding REIT. So a REIT is just a real estate investment trust, which means 90% of their assets are real estate. In Iron Mountain, they have a nice data center business that's growing right now. Like they have their main global records and information. Like they send, like some of their biggest customers are like the IRS, this like paper disposal business right here. Their global records and information management. They just kind of grow single digits. But if we go to their global data center business right here, if our Wi-Fi allows it, this growth is just insane, especially for a REIT. It's up 39% after it grew 25%, after it grew 15%. So they're just on a streak of growth, specifically on their global data center business, and not just their data center business, but if we go to their corporate and other, this is another huge growthy business. It's up 52 after it grew 69. Like these year-over-year growth rates in the middle are why I think Iron Mountain, like most REITs don't really have that much stock price appreciation, but I think Iron Mountain is going to be one of the more growthier REITs because of their data center exposure. Like if you buy the stock right now, even at right now prices, you're getting over 3% of your money back just in an annual dividend. They have a rule where they keep their dividend payout ratio in the mid 60%. So they have a very safe payout ratio for that dividend. So yeah, I'll show you my position. I am a shareholder of Iron Mountain. I got 4 shares of them. Nothing crazy because they're a REIT, but yeah, pretty cool. I'm actually very impressed with how they've done lately. Yeah, Brianna. Yeah, definitely. Hey, Wody, appreciate you, man. Yes, sir. With Moomoo. Okay. What should we look at next? Broadcom, great earnings, RAG. What's RAG? Is that a Transocean? I think this is like a shipping company or some sort of or what do they do? Yeah, oil and gas drilling. So it's an oil and gas contract drilling company. What's the revenue like? So the revenue's up year over year. It's in US dollars. They did $1 billion of revenue, and on the bill of revenue, they made 240 million, but the net income was only 25 million. So they're having these weird one-time adjustments. Like it says they lost 1.9 billion last quarter, but the core business made 237 million. So there's something really weird happening to their accounting right now. Maybe they're like recognizing some losses or something, but uh, when you look at the net income, it paints a much worse picture than they actually are, because the core business, it looks like they're the most profitable they've ever been. But that is something to look into on their net income. That is a little odd. So they're expecting 85 mil net income next quarter, 60 mil. So they do have a forward PE then. What's the forward multiple? A 26. So yeah, 26 forward PE. You know, for an oil and gas stock, a 26 forward PE might be expensive even at current prices. Because, you know, ExxonMobil is at like an 18, Chevron's cheap. So, but my oil and gas play is actually a gas station stock. It's MUSA. Here's kind of my thesis here. The last time oil prices were really high, and it kind of makes sense logically, it kind of makes sense. People don't fill up their tank as much. So people will only halfway fill up their tank or something, leading them to come back to the gas station more and more and more, which actually helps them sell more candy bars and merchandise and whatnot. So Murphy USA is my oil and gas station play, 18 PE and a low dividend, but they do massive share buybacks. Oh, they had a merger with Valeris for 5.8 billion. That was what it was. Cool. So Broadcom, this is a custom chip play. If you heard of Broadcom before, one of their biggest customers are Google with their TPUs. Broadcom authorizes 10 billion share buyback program. So Broadcom projects Q2 revenue of 22 billion and AI chip revenue to exceed 100 billion by 2027. So the Q2 revenue of 22 billion. Well, what's it this quarter? So 18 billion. So this was already a record quarter. If we zoom out to the revenue, it was 18 billion this quarter. And I guess they're expecting it to go to 22 billion next quarter. Analysts project Q1 earnings and AI revenue expected to double, focus on 73 billion AI backlog. Wow. So they have a huge backlog. I didn't even know they had that big of a backlog. Yeah. Upward revision to the $73 billion backlog. Oh yeah, so check this out. JP Morgan expects Broadcom Q1 AI revenue to exceed 9 billion on Google TPU demand. So Google is making their own chips. Meta just bought a bunch of Google's own TPUs, and Broadcom's the one helping Google do that. So they have incredible margins. Like if you go to the revenue is 18 billion. On this 18 billion, they netted $8 billion. It was slightly lower. They had a small $500 million adjustment higher, but they really made like $8 billion. The free cash flow, I can kind of see it from here. Free cash flow is insanely good. It's 7.5 billion, up 36% year over year. They're still a little expensive on a forward basis. Actually, not really. So their current PE is a 64. It looks insanely expensive, but look, it's literally cut in half when we look at next year's numbers. So their EPS is literally expected to double. And let's go check that out. Yeah, that's actually supposed to triple. Look at the net income. It's going on the very left. It's 4.14 billion. It's going year over year to 11.99 billion. That's a record net income. Literally 12 billion net income in 2 quarters. It's never even been close to that by even a little. 12 billion net income in 2 quarters. So that's the future growth that analysts are seeing. They also have a huge VMware business. That's kind of their infrastructure software revenue. Check out the annual growth here. In 2023, it was 7.6 billion. Literally 7 billion. Now for the full year 2025, it was 27 billion, up 20% after growing 195. Pretty insane on Broadcom. So yeah, actually, I do like that one. They're kind of like fairly valued here. They're not super cheap yet, but interesting. Oh yeah, Klarna. So someone said Klarna. This is or what's up? Lucas? What's up? He said Klarna. This is actually a buy now, pay later stock, a good competitor, or potentially. I've looked at both. I kind of think I like Affirm more. It's another pure buy now, pay later platform that's better, potentially, and has better fundamentals. But if we go to the net income here, this company is starting to really print net income. If you zoom back, you know, they used to lose 100, 200 mil a quarter, but now they're actually making good net income every quarter, and the revenue growth is the best part. You know, the revenue is just insanely good. But let's check out Klarna. It's like a smaller, nichier version of Affirm. Smaller, so they're worth $9.7 billion, close to an all-time low. Again, they just IPO'd, so let's see, are they profitable? So the revenue grew 20% year over year, and the net income, so they have lost net income for the past 4 quarters in a row. Let's see if they have a forward PE though. So they don't have a forward PE. So they're not projected to make any net income for the next 12 months. But again, they just IPO. So I really wish I could zoom out and give you more data here, but this is literally all the data we get, these 4 quarters. So it's good to see that they hit a record revenue quarter up 21% year over year. The free cash flow says 920 million. I do know that these buy now, pay later stocks get smoked in a recession as people just don't pay back these tiny loans. But interesting name there. Oh yeah, EOSC. I said I'd get to that one. EOS Energy stock. Monster tastes better than Celsius. Hey, Monster and Celsius. Those are 2 great stocks. Hey, Mr. What do you think about Ouster? Yeah, let's do Ouster. In Celsius, we'll do one of those 2. So here's EOS Energy. Dang, they tanked on earnings day. So yeah, the reason they gapped down on that day was because of earnings. Let's go look at their earnings and see what happens. So yeah, dang, a big miss on revenue. See, stocks don't just gap down for no reason. They gap down because of a real fundamental issue. That's why we focus so much on financials, and we don't do technicals. Like I don't really do like charting. Like I don't draw like whatever, like Fibonacci retracement lines and RSI and all that. I just like judge them off the financials because that's what really moves the stock in the long run up higher or lower. And look at that. For the past 3 quarters in a row, they've been massively missing on their revenue. You know, the sales, the lifeblood of the company. Analysts expected 93. They only did 57. And they missed on net income. They were expected to lose 57 mil. They lost 257. So it was still great. Yeah, look at that growth. That's still what you want to see. But it like if we didn't look at the analyst expectation and just judge this, we'd be like, dang, why did the stock fall? This is incredible revenue growth. Ooh, they are a bit leveraged. Look at that, 3x the liabilities as assets. You know, it's tough when you have all these liabilities and you're actively losing net income every quarter, but we just want to see them continue this crazy top line growth. We want to see them not continue to miss expectations like that because I think that's what's sending the stock down. So Celsius stock, this is an energy drink company. They actually have 28% of the U.S. energy drink market share after they acquired Alani and Rockstar. Dang, they've been struggling these past, ever since earnings, they've been a sharp decline down. They're finally at a very attractive valuation on a forward basis. Because if we look at next year's net income, they're only trading at 26 times next year's net income. So that's that's what Amazon trades at, and Meta's at a 21, but they beat earnings. They expected to see 638. They did 721 million. So if you go to the cash from investing activities, one of the reasons why the revenue is growing so fast is because 2 quarters ago, they acquired Alani. If anyone's heard of Alani before, it's like an energy drink that's like really popular in the US right now. And that's what's led to a lot of their growth as well. And this is their profits right here. They're really profitable. That's where the 26 forward PE comes in. So, no real complaints here. Here's the EBIT, supposed to go from 104 to 194. So they're still experiencing a lot of growth. Is there any kind of earnings recap we can get here? Core Celsius brand showed strong organic growth. Yeah, they acquired Alani and Rockstar, which added $1 billion in revenue, enhancing the multi-brand portfolio. Yeah, it's good that they're diversifying away from just Celsius. So yeah, and Pepsi took a big stake in them. So like Pepsi owns 7% of the company. Pepsi gave them Rockstar Beverage, Rockstar Energy for free. And they're also now going to bottle and manufacture for Celsius. So pretty cool. Please the full IPM of real estate company. Wait, hey, what do you mean there, AI? I don't know what you mean there. Sorry. Google will earn a lot more than the company making chips for them. Yeah, for their TPUs. Yeah, they're selling them to Meta now. All right. George said COHR. What is this? Oh, Coherent. Okay. Is there any news around this stock recently? Was this the stock that got added into the S&P? Yeah, look at that. The second line. Coherent to join the S&P 500. And NVIDIA just bought this company. Literally their stock. So NVIDIA invests $2 billion in Coherent with a multi-billion-dollar purchase commitment for AI data center optics through 2030. They're basically buying a stake into this company to confirm their supply chain. Like they need their fiber optics. So if we go to their revenue right now, yeah, data center communications. Obviously, this is a very attractive sector right now with all the data centers going. So no wonder there's so much hype around this company. The future projections are good. Revenue's going from 1.5 to 1.9 billion. Like, look at that up and to the right. And especially with this new NVIDIA news and S&P 500 inclusion news, I'm really curious to see how they'll do in the future. Net income's going from 38 mil to 197 million. Yeah, like basically EBIT is supposed to double. So profits are supposed to double. that's probably why they've seen so much momentum, because the future expectations are so good. Like there's a lot, like they're going to be making a lot more in the future than they're making now. And here's the revenue right here. Revenue's up 17. Let's zoom out. So look, record revenue. Here's the profits, record profits this quarter specifically. So yeah, 198 million. I can see why they've done so good. They're now in the NVIDIA portfolio. You know, NVIDIA is so big, they're taking a bunch of stakes in a bunch of different stocks. Here's the NVIDIA portfolio. You know, NVIDIA owns Intel, CoreWeave, Synopsys, Nokia, Nebius. They actually just sold out of some companies as well. If we go to sold out, NVIDIA just sold out of APLD, WeRide, RXRX. Coherent is laser optics. Corning is fiber optics. Oh, hey, thanks for that, Fang. I appreciate that context. Monster has the Coca-Cola working for them. Yeah, look, check this out. If we go to Monster Beverage right here, they've actually been one of like an insanely good performing stock. So here's Monster Beverage. We go to the largest shareholder. Yeah, it's actually Coca-Cola. Coca-Cola doesn't really have a successful energy drink, so they're like, you know, let's just buy Monster stock. And so yeah, they're the largest shareholder of Monster, and it's been a phenomenal investment for Coca-Cola. I actually own the Coca-Cola bottler. This is Coca-Cola Consolidated. They are the largest bottler for Coca-Cola. They are the largest bottler for Monster and one of the largest for Dr. Pepper. So they literally just a bottling company. Good little, they've been one of the best performing stocks in history too somehow. Just a boring bottler with crazy pricing power. So Maker said APLD. I think that's the company NVIDIA just sold out of. Let me go back to this. NVIDIA, or was that APLD or wait, is that what he said? Sold out. Yeah, so look at that. NVIDIA just completely sold out of APLD. So this is another company where all this company does is they just own a bunch of NVIDIA chips. They own a bunch of NVIDIA chips in a data center, and they've been crushing earnings. So if we go to the earnings this quarter, analysts expected 81 million. Well, they did 126 million. That beat specifically was very impressive, and they lost less net income than expected. They're expected to lose 28. They only lost 19. Ooh, I guess that was a one-time adjustment though. But anyway, yeah, they're basically renting out the capacity of their GPUs to HPC, data center hosting, and cloud companies. Is there any news around this company recently? Oh yeah, look at that. They actually receive a 10% stake in Base Electron for this huge power plant deal that they're helping build. Do you have a Telegram? No. So actually, I don't have any. I don't have a course, book, WhatsApp, Telegram. I'll never follow you, DM you. Yeah, watch out for people impersonating me. You should look at Duolingo and see why the financials are not everything. Yeah, so Duolingo, this is a sentiment issue, exactly right, because their financials have been great. Actually, well, they did just lower their margins and guidance. Dang, it's all away from the news now. But yeah, the CFO's talking about how they're trying to explain away the margin compression they're about to experience. So anyway, Duolingo, this is a sentiment issue. Basically, Duolingo is an app you buy or you pay a subscription for to learn a new language. And the thesis is in 10 years from now, will people need to learn a new language? If AI technology is so good, like your Meta, Ray-Ban, live language translation technology is so good where people just don't really need to learn a new language. And another unfortunate thing is even at this close to all-time low level, Duolingo isn't exactly cheap. If we look on the right, the forward PE is a 32, more expensive than Google, Amazon, Meta. And we don't look at the PE on the left. It says, like most people glance at this, they don't look at the forward PE, they just look at the PE. They're like, dang, Duolingo's so cheap at 11 times PE. Well, that's an accounting trick. If we go to their net income last quarter, it